Today, we'll be interviewing Lee Brickey, one of the top realtors there in the Port St. Lucie area. Today, we're going to go over market conditions, the Fed hikes, and what we anticipate, how that impacts mortgage rates. And we're going to cover inflation, what the inflation figures look like today, and what we can expect in the coming year. Stay tuned.
All right, Brent, thanks for joining us today. Appreciate you coming on to help us figure out what's going on here with the CPI report and the market and where rates are heading today. So let's talk a little bit about the Fed and what they plan on doing this week. So the way I understand is the consensus is across the board, they're going to raise rates again another quarter point.
That's correct. On Wednesday at 2 o'clock is when the official announcement will be made. And then after that, 2:30, there's a press conference. And so there's three reactions to the initial statement. We'll move the market a little bit as far as mortgage rates are concerned. Then the press, as the press conference goes on, we watch it live, and sometimes you'll see some movements there depending on what the questions are and how the Fed answers those questions. Jerome Powell. The third reaction is actually the next morning after the market sleeps on it. So that's the big news this week, no question.
Where do you think it'll send mortgage rates?
You know, right now the quarter point is baked in. So if they came in at a half point, that would be a complete surprise. Rates would go up drastically. If they pause, rates would go down drastically. So it's pretty much an 85, 90%. There's actually futures market for the Fed. And so we estimate that there's about a 90% chance, if not higher at this point, that the Fed's going to raise at 0.25%. So mortgage rates are already assuming that. So today's interest rates being Monday, that's the assumption right now. So just a surprise is what we're looking for. And the markets are really been flat since Friday because there's really been no substantial news coming out in the last 3 days before it. And the Fed governors are all quiet. Just so you know, there's a 10-day silent period where they don't speak at any economic forums or anything like that, or college campuses or anything. And then Wednesday, Thursday, and Friday, it's a busy week as far as all reports. GDP is coming out Thursday, and the personal consumption expenditures report, the Fed's favorite grades for inflation, more than CPI actually, is coming out Friday. It's a very busy week.
So we'll get on that next week. Let's talk about what happened over the last week with CPI reports. All right, so let's take a look at this consumer price index here. So this is year over year. This is Charlie Below's charts that we listen to. Charlie's a super smart guy. We'll leave his information so somebody can come and watch this video after the fact. If you want to spend half an hour watching it, it's really good. So anyways, Charlie does these graphs, and he's showing here the CPI, core CPI, sitting at 4.8%, but the year over year and the CPI year over year is at 2.9%, which actually came in lower. They were expecting it to come in at like 3.1%, and actually came in a little lower. This is inflation without energy and food. This is where we are today. We're moving towards where the Fed wants us to move. I mean, obviously what they've been doing is working. No matter what you think about it, it is actually working. So a lot changes over a year here. So where do you see mortgage rates following this eventually?
Well, in our world, we look at the month over month as well, CPI, and it's reported at the same time the core and the CPI index year over year is reported. And what we're seeing is the months that are falling off. That's why you're seeing such a drastic decline. And we know it's going to go down because you can see 12 months ago what months are falling off. The all-time high was actually June of 2022. So we've been going down steadily since then, and in continuing to get rid of those higher months. New months coming on, and that two handle, we're going to be right around there quickly. So we think that the bond market's saying this actually. It's an inverted yield curve, and the quick explanation of that is 2-year yields are higher than 10-year yields. In other words, an investor that buys a mortgage, because your mortgage is someone else's investment, someone's a 10-year treasury. In other words, and the mortgage industry models or mirrors the 10-year treasury. It's not controlled by the 10-year treasury, but it's a good gauge because it feels like a mortgage. It's guaranteed by the government, which is comparable to real estate, where there's full underwriting and all of that. So it models that or mirrors that. And then right now you've got 2-year money, with returns offered from the federal government that are almost 75 basis points or 3/4 of a point higher. So the market's saying, hey, we know that right now a 10-year treasury is going to be a bargain, at 3.75%, 3 years from now. So we're going to get that lower return. We're going to be okay with that lower return, a lower return on mortgages right now, because we know that rates are going to be coming down. So as these months fall off, Lee, the months that to make up that 12-month year-over-year figure, when those higher months continue to fall off, we know it's going to continue to go down. There's no question about it. Mathematically, it has to. So we're seeing interest rates coming down already in response to this, to answer your question. And so we see that in the big picture. It'll be a choppy ride down, but they're definitely coming down. They have to.
So you see rates going, maybe fluctuating back and forth a little bit, and then eventually coming down.
Right. And I think the big picture, a lot of the talking heads out there that really are good at estimating these things are, some are saying 2% in the next 2 years. It'll be a choppy ride to get there, but I think I tend to agree with them. At some point, we're going to see substantial move down as inflation gets under control.
Here's the second chart that he puts together. It's a year-over-year change, and it goes through every single category. And I think this is important because we're seeing things change here. You can see where shelter is actually up still year over year. That's rental prices. So, but we're seeing that come down with our clients are having to lower their rent. So that's a lagging indicator, obviously, because there's a year lease connected to that. But we're on the ground when new properties come available for rent. We're seeing them drop $100 to $200 a month.
Why is that, Lee? I mean, I know why, but I think it's good to know.
It's because most people are not selling their homes. If they are moving, they're renting their home. So because the rates are so low, they can cover the mortgage with the rent easily. So and then they're buying a lot of them are buying new construction. We're finding that a lot of our clients are buying new construction and renting their home and then taking that money to use towards the mortgage because the rate's so high. So it's kind of offsetting the higher mortgage rate by renting the house. And then
we're seeing that. They don't want to let go of that 3% interest rate. That's the problem.
Right. That's going to be difficult to get through. That's the biggest problem we're having in the market and why it's so locked up. Overall, CPI is down from 9.1% from last year to 3%. So that's great. And then you look at used cars, that's in the negative right now. Gas and utilities are coming down. Gasoline, we can go down here and see where, we see that fuel oil's coming down, gasoline's coming down, utilities are coming down, used cars are coming down, not a whole lot, but coming down. And then new cars are coming down just a tad. Food at home, here's a big one. I mean, I don't know if you know, been in the grocery store lately, but eggs are back to like $2.50, instead of $5. So that's come down dramatically, and electricity is coming down. Food away from home, that's about the same now. So, but this food at home is going to probably start pulling away from that full food away from home some now, because a lot of people were just going ahead and having their meals prepared and buying stuff out because it was just a little bit extra money without the hassle of having to cook at home. Shelter, obviously, we're seeing that, we're still up over last year, but I would say by the end of the year, we should see shelter really dropped, back into an affordable place.
That's moderating. No, I think you're right. And I think the big point in this is the shelter, because obviously it's what we deal with, but the market's very different. These wide swings with what the Fed did as far as not doing anything for a long time and then slamming the brakes on the economy with these higher rates. It caused this kind of a whipsaw. So it's starting to level out, and it's a market that's actually healthy, is what we're going back to, which is a good indication. And keeping a solid jobs market, that's also another thing that, the jobs are really what, fuels the real estate industry, right? And housing. Right. So, and we're still solid there. So I think it's going to level out, this is really good news that it's just moderating.
Right. I mean, it's a big decrease from a year ago. So, and the job markets remain very strong. So, I mean, I know that's a concern of the Fed, but there's still 1.6 jobs out there per person. So if you lost your job, you can get another job. So that the job markets remain very strong, and the administration touts it. But I think on the other side, the flip side of that, the Fed's not 100% happy about it. I know that's a terrible thing. I don't understand that.
I understand that. But when a lot of the new jobs are created, or second jobs too.
Right. I mean, it's fueling the economy right now. Manufacturing is really up right now in the U.S., and I think that's a good thing. So
I do hope you found this information helpful today. Be sure to subscribe to our channel, and also for Lee Brickey's information, you can find that down below, and ring that notification bell so you never miss an update.